Hey folks, how you doing? My name is Jeff Benjamin, Wealth Management Editor here at ETF.com, and this is Advisor Insider, powered by ETF.com. We're talking today with Don Benioff, the founder of Benioff & Co., a CIO firm for an outsourced CIO firm for financial advisors. What this episode is about, though, is the Portfolio IQ series that we have here at ETF.com. What we do is we take a professional in the industry, in the financial planning industry, in the wealth management industry, and we ask them to voluntarily share with us their personal portfolio. Now, we don't ask for assets or dollar amounts. We're just looking at their portfolio, how they invest at this point in their life, where they are. In Don's case, 59 years old, recently started this business after going into semi-retirement for about a year or so. But I think you're going to be really surprised and impressed, folks, with this portfolio. I would call it concentrated. That'd be the way I would sum it up. How you doing, Don? Let's get started.
I'm great, Jeff. Thanks for having me.
All right, I want to set the stage a little bit here. Don is 59 years old. I talk about that when I do these portfolio IQs because it's important to have the context of where somebody is in their investing and saving and working lives. Don is a head of a single income household. He lives with his wife and two, I guess, adult children live there with him. I think you said they moved in with you during COVID and are still there.
Exactly.
Yeah, that's just context on what you're dealing with in terms of maybe overhead and stuff like that. But here's the money shot here. Don's portfolio is divided between about 64% of his investments are in the Vanguard Total Stock Market ETF, ticker VTI, and 36% in cash. Now the cash is a new phenomenon. Up until I think May of 23, when you were working somewhere else, you had that you were 60% in the Vanguard Total Stock Market ETF and 40% in Vanguard Total International Stock ETF VXUX. Okay, so let's start with that. You were 100% invested in equities. You're not somebody in your 20s just starting out, you with a 70-year time horizon ahead of you or something like that. But you said this is the way you've always invested, right, Don?
Yes, Jeff. It's always been kind of my core to think about things in the context of building, the portfolio to suit my temperament, not only my, desire for growth.
100% in equities. All right, it has to have introduced some wild rides.
Absolutely. I've been in the industry for over 30 years. And so, yes, we've seen plenty of smaller hiccups as well as some large ones. And, each of those has taught me different lessons and has actually led me to have a very stress tested opinion about my perception of risk and future uncertainty. And so each of those events actually made me more and more comfortable that 100% stock allocation wasn't too aggressive for my personal temperament.
Yeah, you must have a temperament of steel. We talked about this, Don, when we were talking earlier. The period between October 2007 and March 2009, officially, I guess, known as the financial crisis, you said that your portfolio sank by 55%. I mean, that has to be something that there must have been some point where you were saying, what the heck am I doing? Or were you?
No, there were a lot of points I was saying, what the heck am I doing, Jeff?
Mm-hmm.
But I think, more to the point was that because I had conviction in what I was doing, I had selected a broad market portfolio of index funds, such as total stock market, total international stock market. One of the things that helped with me dealing with the uncertainty of what was going on was that I had the confidence that I wasn't leaving money on the table, if that makes
Mm-hmm.
sense. because I chose index funds and index fund managers that do their jobs extremely well. I got the returns of the market. I didn't do any better and I didn't do any worse, which is really important because
Hmm.
during periods of uncertainty like that, the the added the really the most pernicious aspect of uncertainty in my mind is the doubt that it creates when people don't have that conviction. They're not sure if they're using the right strategy, they're not sure if they're using the right funds, and they begin to doubt what they're doing. And invariably, it causes them to make some changes that they would otherwise regret when really, the stock market resumes its more typical upward path.
Right. It resumes its more typical upward path, but the ride that you're on is is extreme. And there's probably a reason, or that's probably the reason why most financial professionals recommend a maybe a more diversified allocation. And I that's what I like so much about this story is that you're not somebody who is just kind of messing around. You know what you're doing. You're in the industry. You're a grown up and you're a professional. And you're saying that it can be done this way. Do you have an aversion to bonds, or you just not see them as something that's going to help you reach your financial goals, or what is the reason you don't have any fixed income?
No, I don't have an aversion towards bonds. And, quite frankly, you know, with, in our previous conversation, you asked about the cash and,
Hmm.
part of the context is that bonds are definitely a great balance for the volatility of stocks. It will help dilute the volatility that we saw. It doesn't necessarily diffuse it. In other words, it doesn't necessarily um, get rid of all of the volatility. So there's still plenty of it.
Hmm.
But in the current situation, with the yields on cash, the um, the inflation trends we've been seeing, my cash allocation is yielding about 1.5% after inflation,
Hmm.
which historically has been a little better or about the same as the long run real return on a more diversified bond portfolio.
Hmm.
So, one of your questions you had asked in terms of the the question of why cash, not bonds, is that I wasn't trying to enhance my portfolio return by trying to hope for higher returns from bonds because I was getting the required returns or the returns I needed to achieve my goals from cash as it was. Now, those cash returns aren't fixed and that will change in a little while, or at some point in the future rather. But for the time being, I don't have any rush to consider something like a bond allocation.
Hmm.
But that's not how everyone's temperament is built. I can endure a 55% loss in my stock portfolio,
Hmm.
knowing that if I'm patient and there isn't some permanent circumstance where we have a rift in the traditional mechanics of the stock market, then if I am patient, I should probably reap the rewards of that patience. But not everyone's built that way.
Right. To be fair, some of the things have come to you. And to back up a little bit, when you had that 60/40 allocation to the Vanguard Total Stock Market Index and the Vanguard Total International Market Index, you were employed. Um, you in May of 2023, you went into a retirement phase. That's the point where you decided to discard the international exposure and move that to cash because of what's happened with interest rates and trying to fight inflation and everything else. It's you've been like everyone else, been getting paid well to sit in cash. So I think it's probably safe to assume that that cash position is a somewhat temporary, but still you do have a very optimistic and essentially a bullish outlook for equities, and you clearly appreciate the kind of the upward bias of the equity markets. And I got to imagine it's helped you. You must have performance over the years of doing this that is that is probably blown away any financial advisor that would have his clients in a 60/40 portfolio or something like that, right?
Well, well, I'm not sure if I can say that, but I would say that I haven't left money on the table. Again,
Mm-hmm.
by choosing to accept the returns of the market, I'm
Mm-hmm.
I'm I'm knowingly not trying to outperform the market, which
Mm-hmm.
quite frankly, few people really do consistently over time, and most underperform. And to me, that's the most important thing, is that again, by accepting the returns of the market, whatever they may be, I'm reducing the opportunity for doubt to creep in that I'm doing the right thing. I trust the basic mechanics of the stock market to continue to be the same in the future as they are today or they were in the
Mm-hmm.
past, and know that whatever that return of the future is, whether it's up 10% or down 30%, I should fully participate in that. And I shouldn't do better or worse without something really being wrong.
Right, but
Um,
one could argue that if you were more diversified, you might not do as bad.
oh, without a question, I can the path of the returns, the volatility will be different.
Mm-hmm.
But even my 100% stock allocation, whether it's today entirely in VTI or in the past when I used Total International, um, it's also important to understand that there are a lot of different ways to achieve 100% stock allocation.
Mm-hmm.
I chose to use two broad market, low cost, well managed index funds to get comprehensive exposure to the global stock markets.
Right.
Alternatively, I could have used actively managed funds. I could have used full active management where maybe I relied on secure, trying to pick stocks or time the markets. There are a lot of different ways to achieve 100% stock allocation. And what I chose was what I consider the least volatile of those choices
Right.
because I'm fully
Yeah,
diversified.
yeah, clearly, it's not fair to say that you're not diversified if you've got, the entire US market, equity market, and then at times the entire global market or most of it. That's diversified. It's diversified in equities. Not having any fixed income, no commodities, real estate, gold, whatever. And really the question is portfolio management this simple or can it be this simple? Are we overcomplicating the whole thing?
In my opinion, I think the industry overcomplicates things, and I think um, it's pretty obvious why. The industry is in the market of selling investments to people that usually don't have them. There's
Hmm.
nothing easier to sell to someone than something they don't already have.
Right.
We see a lot of what's called, financial innovation, but quite frankly, it's creating a very crowded opportunity set for investors where
Hmm.
they have thousands and thousands of even index funds and ETFs where they're not all cut from the same cloth. They don't all share the same risk and return characteristics. And quite frankly, it can be overwhelming. I don't think most people need to start there. I think most people can do things that are as simple as, choosing a portfolio that's broadly diversified, but has very few moving parts and maybe very few funds that make up its portfolio construction.
Hmm.
There's absolutely nothing wrong with someone choosing a very simple portfolio, mainly because they're covering the diversification aspect to it. I think they're helping, again, dilute some of that uncertainty because they're removing an aspect of doubt about am I leaving money on the table? Maybe, maybe not, compared to other strategies like, that tend to be more active.
Mm-hmm.
And I think most people should start with a simple approach and then adapt their approach to fit their needs. For many people, they can choose a target date retirement fund or a target risk retirement fund, a set asset allocation, in their portfolio, and stop there. They don't have to make things more complicated. Most of the time, they choose to make things more complicated because the industry is constantly selling them that a lot of these opportunities that they frame are better mousetraps, and quite frankly, very few of them really pass that test of time and performance.
Right. You're 59 years old now. You tested retirement briefly once. How do you see this portfolio evolving as you get closer to retirement and into retirement? Do you see yourself sitting 100% in equities as you're moving into and through retirement?
I do for the foreseeable future, but you mentioned earlier, I think, a very critical component in the mix. Like when when you're looking at asset allocation,
Hmm.
it's a factor to understand, particularly for younger investors, for example. Um, Everyone should learn about the concept of asset allocation and what it entails. It's the it's the trade-off of risk and reward,
Hmm.
and they should understand those mechanics because those mechanics are part of those characteristics of the financial markets that I mentioned that I don't think are going to go away. I think risk and reward are related. I don't think getting a higher return simply for taking risk is what anyone believes is the most certain outcome. People understand that, especially for younger investors. Understand how risk and reward and asset allocation work together, but then don't get too hung up on it, trying to figure out whether 50% stocks or 70% stocks is the right portfolio. The difference between those two is less important for younger investors, for example, than your contribution rate. Simply because if you're a younger investor and you're starting to build wealth, and maybe you've built a $10,000 401k and you're
Hmm.
contributing every month, if your monthly contributions over the year add up to another three or four or $5,000, your wealth is growing by that amount through your contributions. And even if you lose 20% through stock market returns, you'll still be better off than if you didn't contribute that money at all. Because the contributions when you're building wealth usually contribute way more to wealth creation than the returns that you get from the investments in the portfolio, which is
Okay.
why I say keep it simple. Focus on those factors that really drive uh, the the positive outcomes
Mhm.
early on. For my two sons, for example, I tell them to focus on contributions, and beyond that, their asset allocation. I encourage them to to think about having an equity heavy portfolio, but I also want to make sure that they reduce that doubt that they're throwing good money after bad in case something bad does happen.
Hmm.
On my own case, for the near future, I would think that being 100% equity is going to be the likely course, and having income from my business to continue to contribute um, is an important factor when you lose that ability to have discretionary income that you can add to your portfolio, which can, again, if the market does drop and you're adding, you can help kind of temper that downside. Without that ability to contribute extra capital to the portfolio, you do have to
Hmm.
be a bit more sensitive about that volatility because it can work on your psyche.
Yeah, well, it certainly made me rethink the way I'm invested. Feels like it. maybe I'm overcomplicating things, but would you recommend this strategy to anybody? And I also want to ask you, what kind of, not that we all sit around cocktail parties and talk about our personal portfolios, but you must have shared this with some people who are maybe friends or family, and I'd like to know what they think of it.
Actually, you'd be surprised. My friends, I think I've picked because we don't talk about our portfolios. We get enough of that talking with advisors and clients. But yes, I would recommend anyone start with the simple, and then have
Hmm.
a very good reason why you might deviate from from that portfolio. Now, when I talk about simple, it doesn't have to be index funds. In fact, I encourage financial advisors when they're looking at the choices to think about this idea of it's never index or active. There is a compromise, and sometimes you can also have a combination of using index and active, depending on what you're trying to achieve and the client's feelings about risk. Again, if they're trying to beat the market, an index fund isn't going to really do that for you.
Hmm.
So, think about it in the context of a starting point, and then move from a simple portfolio because you need to, or at least admit that it's because you want to, not because you're buying, what the industry is selling in terms of their
Right.
potential outperformance.
All right. We're going to leave it there. Don Benioff, really good stuff. Interesting. If you're going to try Don's portfolio strategy, you should buckle in for a ride. But you got to believe, right, Don?
You have to. It's definitely a know thyself portfolio.
Okay. All right. I want to thank Don Benioff, Benioff and Co. I want to thank our audience and encourage you to listen to Advisor Insider. You can find it at ETF.com along with our weekly podcast, Exchange Traded Fridays. Uh, if you'd like to be featured in a portfolio IQ profile, reach out to me, jeff.benjamin@etf.com. And check out the Advisor Center at ETF.com, where we have all kinds of things for financial professionals. Till next time, I'm Jeff Benjamin with the Wealth Management Editor here at ETF.com. Thank you very much.